Everyone, and welcome to All About Stock Trading. Today, this event is brought to you by Timing Research and Trade Out Loud. The event is being recorded, and all the recordings will be available as soon as they're being processed. And they're going to be available on the TimingResearch.com website and also on the TimingResearch.com YouTube and podcast. David will be posting the links to these locations where you can find the recordings throughout the day. David Conspiner and I, Anka Metcalf, will be your host today. So let me just remind you that before we begin, all information provided today is for educational purpose only. It should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, or any instrument of any kind. I'm pretty sure you know by now that trading involves a high level of risk and may not be suitable for all investors. You could lose money. Before deciding to trade, you should carefully consider your objectives, level of experience, and risk appetite. Individual performance depends upon each person's skills, time commitment, and effort. So with us today, we have Serge Berger. And Serge, you have the mic, and tell our viewers a little bit about yourself. And also, we're really excited for you to dig into this option strategy for steady income.
Sure. Thank you, Anka and David. I appreciate it. I will go through kind of my background here in just a few minutes so you guys can kind of handicap where I originally come from and what my thing is. But, you know, what we have found is that one of the major pain points for traders and investors is that there's a lack of a steady stream of positive returns, where they fall into that trap of having a few good trades and then, you know, they have one or two that kind of wipes everything out again. And I'm sure a lot of you can probably, unfortunately, relate to that issue. I'm just going to quickly bring up the chat room so I can see if there are any questions coming through. But I think before we really look at all of that, I want to just spend a little bit of time in terms of the broader market. And in order to do that, I thought I'd bring along a few charts to kind of give you some perspective on where we think the market is, and ultimately I will show you how you can start using this strategy, which is just a couple of tweaks, a couple of small tweaks from me probably already doing to have a much steadier stream of positive returns. What you're looking at here is a simple chart of the S&P 500. We've been showing people this chart for our clients really for the most part of 2020. And what you have is this very simple, this is just a simple technical thing, but it's a microphone pattern or megaphone pattern. Not a microphone, a megaphone. And basically, if one were to sort of extrapolate this to the future, one would think that you could see this retrace all the way back down to the March lows. Now, that's not my base case, and I'm not here to fearmonger, but you know, just to kind of show you where we've gotten to. And I do think the upside, or at least meaningful, sustainable upside from here, should be quite a bit more challenging. We monitor the behavior of investors both on the institutional and on the retail side quite a bit. And one of the things that we have noticed is that I think a lot of people were aware of the extreme amount of call buying, upside call buying in August into early September. And even though that's come down a little bit, it still does remain quite elevated, the call buying. So there still is a lot of people that are essentially, as I titled here, rolling the dice. And I think ultimately that is going to cause pain for individual investors that are not using strategies that are well fit for more volatility. Other signs that make us kind of sit up and notice is this ETF I came across a number of weeks ago, which allows you to get 3 times exposure to Tesla. I don't know why anyone would do this, nor why anyone would issue such a product, but it's there, and it is a little bit concerning as far as I'm concerned. We've already seen some victims on Twitter, people that were overly extended into just a few tech stocks, and it took one down day in September, and you can see this person was out. So what we're going to show you here today is how you can avoid this. So one of the things you might be asking yourself, how can I avoid these constant drawdowns? And that's going to be one of the things that we're going to address here right now. This here is kind of showing a similar thing from earlier. Again, a lot of people still buying calls. The put to call ratio, or in this case, call to put ratio, has certainly come down, but it's still very, very elevated and still quite concerning. Equally concerning is that all the volume is actually in the options market. You can look at this line here, this green line, how it shoots to the upside in the upper left right-hand corner of the chart, where we're just seeing an explosion of options volume versus volume in equities. And again, I think something that should be quite concerning for a lot of people. At the same time, in late August, early September, when the NASDAQ 100 and other things blew higher, only about 30% of equities in the S&P actually pushed above their January, February highs, which I think is quite concerning. And we will see how this shakes out going forward. But ultimately, this kind of stuff isn't very healthy for the longer term. In terms of seasonality, we just exited, just yesterday actually, on the last day of September, we exited what historically is the worst back-to-back months in terms of performance. If you look at the August-September period, that is historically speaking the worst 2-month period throughout the year in the for equities for the S&P 500. If you look at the next batch of months here, which would be October and November, you can see that is a notably positive period. Now, of course, we do have a bit of a special situation here in 2020 with COVID, and we do have obviously an election coming up as well. But quite frankly, you can pretty much always make the argument that this year is different or any year is different. So I'm not quite sure I want to overrule the seasonal patterns too much, although they should be taken as just one part of the analysis. So if we look at the remainder of the year here in the first day of the fourth quarter, lots of interesting things to focus on, lots of important things to focus on, from general economic numbers that continue to be, I think, underneath the surface, not as great as people think. Obviously, the election, COVID-19 unfortunately needs no introduction, and then we have this zero interest rate environment that is still a real major overhang, I think, for a lot of investors out there trying to figure out what to do with that. If you're wondering what a typical fourth year presidential cycle year looks like in terms of equity performance, you have a pretty good chart here. And what this is essentially looking at the 3 months in the summer. You can see they tend to be quite green and or positive, and you can see that indeed has happened. Then you tend to see worse performance in September and October. So far, that's held true. And then when you go into November and December, you tend to see pretty good moves to the upside. So seasonally speaking, historically, going back with data to 1928, there is a pretty strong tendency for this pattern to play out. And again, will remain to be seen what exactly is going to happen going forward. This post-election rally chart is more or less the same thing. We are expecting volatility to increase more into the election. This is a historical chart, again, going back to 1928 with data. And you can see that the volatility does tend to increase all the way through November. So we'd expect October to be a bit more volatile as well. The futures market, or the VIX term structure as it's called, is actually already pricing this in. You can actually see the November VIX is still notably above 30, actually all the way through December. And that's quite unique this year in the sense that we have past the election volatility remaining quite elevated. And I think when I talk to our institutional investors and other professional investors, we see them hedging as well, really all the way out to January, expecting either COVID to be an increasing problem again, or potentially something around the election. So it's kind of a hedge in multiple ways. Well, I do think that we've entered a new era in January of this year when we came into the new decade. And here's why. If you look at the S&P 500 over the past 90 years, 90, then you can see that it's returned on average about 9.8%, call it 10% on average. If you look at the past 10 years, though, the decade that we just exited 9 months ago, the past decade, the S&P's returned about 14%, 1-4. And that is obviously way above the long-term average. In fact, it's 40% more than the long-term average. And we don't think that we'll see anything like this for the next decade, or at least not the next 5 years. And as returns have been brought forward due to low interest rates and some other factors. We think we're going to see an environment that has much lower return potential in the S&P on an average year, maybe closer to maybe 2 to 4% or so on average. And make no mistake about it, that's going to be a problem for a lot of people. And we do think that the passive investing bubble that we currently experience is going to see some deflating, and a bit more of a proactive approach, or at least an approach with better risk management, is going to be required for the next few years. So if you're someone that's kind of banking on a 10-15% return in the S&P, I think it's going to be very challenging for the next decade. Whether you're retired or soon to be retired, or you're working part-time, full-time, in any of those scenarios, that's going to be an issue for a lot of people. And we're here to show you how you can make this a whole lot easier for you. We're not alone in this camp. I think it was just last week Blackstone came out talking about a lost decade potentially for the equity market here going forward. A couple issues that I want to touch on before we start looking at the strategy. One of them being U.S. corporate buybacks. That's the blue line on your screen. And what the screen indicates, or what that blue line indicates, is that really the majority of the equity rally for the past decade has been a function of U.S. companies buying back their own stock. Well, as you can imagine, through the COVID situation now, the past 6 months or so, we've seen a lot of companies either halt or reduce their buyback programs. And so one of the questions that remains open is, to what extent will there be, or who is going to be the marginal buyer of equities going forward for the next number of years? I'm not sure there is an answer, but it is certainly something that we need to be concerned about. Moving on, just a couple more things. I flipped through most of these charts just to put this a bit more into perspective of kind of where we are. Apple just a couple of weeks ago made up, I think, 7% of the S&P 500. The only other time we had a stock that was anywhere near that kind of chunk of the S&P was IBM back in the early 80s. And as you can see, that didn't last very long. So I don't think, these mega cap tech companies are going to be around these levels in terms of market cap a whole lot longer. And that should kind of stall the upward trajectory of equities, at least for some time being. What is very bullish, though, is gold. Multiple reasons for that. You can look at this from a macroeconomic perspective, which makes a lot of sense, but also maybe from central banking policies, meaning a lot of monetary debasing, or money printing, as they call it in layman's terms. We think gold could see a 2,800 handle, maybe 3,000 over the next 12 to 24 months. So that's just as an FYI. The bond market continues to tell us a very different story than the equity market. So that's just some of the things that are happening here. Just to quickly check in here, folks, I would love to hear if these charts and this has been somewhat helpful here. And by all means, type in yes if that's the case for you. If you want to take a picture of any of these screens, or these charts that I made or am making going forward, do let us know. And I'm trying to see. Hey, David, I'm not quite sure I can see the questions here. If there's questions coming in or coming through, just as an FYI.
There isn't any yet, but yeah, if you move your cursor to the top of the screen, it should pop up the Zoom thing, the Zoom panel, and then you should see a more button and chat.
Yeah, I see chat. Oh, I see. Gotcha. Okay, gotcha. Perfect. Yeah, I was on there. I just didn't see any questions yet. Perfect. Cool.
Okay. Yeah.
Thank you. I appreciate it. All right, guys. So let's move on. Just quickly give you some perspective. This is yours truly. I'm sitting literally in the same exact spot right now in my office. I originally come from a bit more of the sort of investment banking side. I was a banker at JP Morgan, and moved on to family offices and hedge funds. And I am the chief investment strategist and hedge trader at TradeOutLoud.com, and I'm also a founding partner and the chief investment strategist at Blue Marlin Advisors, which is an RIA, which stands for Registered Investment Advisory Company. It just means we manage money for people. So what we have noticed is, as I said earlier, is that a lot of people have a really hard time trying to have a more positive stream of returns when it comes to their trades, whether that's month over month or quarter over quarter. And you can see what it looks like here in terms of performance. I just took an average year in the S&P 500, and I've broken the returns down by month. And you can see on average, you tend to see big up months, big down months, and everything in between. And for a lot of people, in fact, most people, that doesn't work because they're looking for something steadier than that. And most strategies, believe it or not, are actually very closely correlated to not just necessarily the directionality of the broader equity indices, but also the volatility. So if the S&P has a big up month, they do well, and if it doesn't, then they don't do well. And that's a problem over time. So I have one question for you guys, and I'd love as many of you as possible to just quickly answer this question. How many of you would say that it is one of your goals to have some sort of a positive month-over-month or quarter-over-quarter return stream or income stream from the stock market, from your portfolio? Type in yes if that's one of your goals. And again, I'd love for as many people as possible to participate in that, and there's a reason for that. Because what we have noticed is that most people have that as one of their goals. And a lot of people are actually not even aware that that is one of their goals. And so, because of that, I like to ask the question so people are actually aware. What we're going to show you here is a strategy that doesn't do this business here that the S&P does, or equities do in general, but looks a lot more like this. I mean, for one, you can make a lot of money with it, but really more importantly, you can see the return stream is much steadier, right? And that's really what we're looking for. So if you look at the S&P, even just this year, looking back at some point when I took this chart, just 12 months, I should probably update this. You can see completely random. There's up months and down months and everything in between. And for most people, that's just not sustainable. And here is, in fact, what most people's returns look like. You're looking at the mountain range here is what I'm trying to point at. You can see how it's kind of jaggedy. So a lot of people, they'll make some money for a few trades and they do very well. And then they have one or two trades and it wipes it all out again. And then they have another few trades that do well, and then one or two that really go badly. And they continue doing this for a while. And ultimately, what it leads to is frustration. Frustration to one extent because to some extent because they're not making money, so it's a financial problem. But frustration also psychologically because they're putting in a lot of time, and then they're always back to square one. And I'm sure a lot of you can probably relate to this. And if that is one of the things that you're struggling with, by all means, do let us know in the chat box. So what we've noticed of working with traders and investors of all types, institutional to retail, for the past 20 plus years, is that there's a strong desire, but also a need to have some sort of a monthly or quarterly positive return stream over time on average. And I want you to think about this. How much more calmly would you be in the markets if you knew that you had a steady monthly income? So if you knew that at the end of the month, someone were to give you whatever, 3,000, 5,000, 10,000 bucks, whatever the number is, wouldn't you agree that you'd probably be more calm and collected and actually stick to a trading plan and be less hectic and nervous about things, right? And the answer, of course, is yes. So that's exactly what this is about. And again, whether you're working full-time, part-time, not working at all, retired, semi-retired, this is going to be something you can do because it doesn't require a lot of time at all. So the next level to this is the following. When you have this stagnating or losing account, because you have this pattern of a few good trades and then one or two bad ones that wipes everything out again, it leads to a loss of confidence in not only the strategy you're deploying, but also in yourself. That in turn leads to breaking rules and forcing trades, and before you know it, you're essentially gambling. And that's really when things really hit the fan and you basically blow up, or a lot of people just give up. And I'm going to show you guys something with a couple very simple tweaks to what you're already doing probably that is going to make a huge difference. So what we'll show you is this strategy right now that is very low stress. It's high probability, but the most important thing to me is that it's very repeatable. It doesn't really matter what the market environment is, you can repeat this. It doesn't require a lot of time, and we're talking about a strategy that out of 10 trades should have roughly 8 or so being profitable, and the 1 or 2 losing trades on average are not going to wipe out all the gains of the past 8 trades, right? Now, at the very core of the strategy lies this phenomenon of steep slopes that have gone vertical. Everyone has seen a steep slope that goes vertical. Just look at the past few months. And at some point, when you have that steep slope go vertical, at some point the asset in question, whether it's a stock, commodity, currency, whatever it is, at some point it just simply can't go higher for a period of time. Same thing on the downside, steep move to the downside, then a parabolic drop, and at some point it just simply can't go lower for a period of time anymore. And so when you have these steep slopes go vertical, options get more expensive. In other words, implied volatility becomes a little bit elevated or just increases. Investor fear or greed reaches extremes. And ultimately, the reward to risk for what I'm going to call a counter trend trade for right now, it become absolutely amazing. Now, when we talk about options, I think a lot of people get exposed to options as a way to leverage their returns, which really just means adding more risk for a lot of people. And I would imagine that a lot of you in here have used options before, and it doesn't really matter at all whether you have or not. But here are some statistics that people will tell you. People will tell you that the odds are strongly in favor of people who sell options. And the reason for that is the following. What they'll tell you is that more than 75% of options that are held to expiration, they expire worthless. In other words, if you buy a call or a put and you hold it to expiration, you by definition would only have a 25% chance of making money. So the longer you hold your short option, then by definition, the more money you should make. But that's actually a very, very difficult and I'm going to say dangerous statistic to believe. It's true technically on paper, but unless this is done right, it doesn't work, and it's very, very difficult and dangerous to even believe that. So a lot of people will try to play this time decay game. They use short-dated options, and it ends up, being a source of pain for most people. What we want to do is we want to follow these 4 steps together right now for the next little bit here. And we're just going to rinse and repeat this ultimately on a monthly basis to really generate that income machines. These are 4 simple steps. The first thing we're going to do is we're going to look for these steep slopes that I alluded to that are going to go vertical and give us a sign of exhaustion. When that happens, we want to make sure the implied volatility is at least somewhat elevated. We want to make sure that the liquidity in options is good. And then very specifically what we're going to do is we are going to sell what's called a far out of the money call or put spread using options that expire 2 or more months out in the future. Now, if you've ever done a credit spread before, I can just about guarantee you that you've never done this before. We do something very, very specific, and we can see that almost no one out there that's outside the institutional world actually does this. I've done this now for 20 plus years for institutional clients, and we've recently started a real sort of revolution among retail investors as well, showing them how this actually works and how they can actually make a much steadier stream of positive returns. So again, what we're looking for is these steep slopes that go vertical, and at some point they become so exhausted that the asset in question, whether it's a stock, index, commodity, whatever, just simply can't go higher for a period of time. For usually 1 to 2 weeks is our time frame. Same thing here, you can see Netflix, steep move gone vertical, and then at some point it just reaches that point where it simply can't go higher for a, again, 1 to 2 week period is what we're looking for. So again, in other words, when steep slopes go vertical, then the upside essentially becomes capped or limited. And when that steep moves to the downside, the downside becomes very limited. And so, in other words, the asset will tend to stall in price for what we're looking for is about a 1 to 2 week period. And oftentimes what you'll find is that there'll be some sort of a mean reversion move that happens in the opposite direction. And while that's not our base case, it is something that you'll see kind of happens as a bonus payout every once in a while to really kind of juice the returns in addition to the steady income. So let's have a look at a few example trades here and make sure you understand this. What we're going to do right now for the next few minutes is we are going to look at a couple of historical examples so that you understand what we're actually doing, and I'm teaching you the strategy right now. And then we're going to go into the live market together, and I'm going to go into the live market and take some tickers you want to look at, so I can prove to you that this works. So I'm not only going to teach it to you right now, I'm also going to prove to you in a few minutes how and that this actually works. So what we're looking at here is a very simple chart of Facebook. And you can see at the time, Facebook had an orderly move to the upside within those two parallel lines. But every once in a while, it would go vertical, right? You can see it went vertical here and here and here. And ultimately, what happens is when the stock goes vertical, it is going to, yes, mean revert lower, but more importantly, it's going to stop going higher, right, for a period of time. So when the stock goes from steep to vertical moves, at some point, it's going to exhaust itself and not go higher for a period of time. And that's exactly the point in time we're looking for. So let's go and actually look at, I'm going to bring up my actual charting platform so I can show you this here in real time. Quickly drag it over. So again, we're looking at the chart of Facebook. And let's assume we, again, moved along here in this channel that I showed you a few minutes ago in this steep move. And then the stock went vertical and it reached the upper end of this channel going vertical. Let's just assume that that's where we're at. Well, once you reach that point, what are some of the things you could do? Well, one of the things you could do is you could probably, if you own the stock, you could probably take some profits. I would assume everyone would see that could be part of something what you might do. What else could you do? Well, you could, if you want to be more aggressive, you could buy a put. You could short the stock, right? But who can tell me if you're going to go ahead and short the stock at this point? Oops, let me go back. I just clicked away my charting platform. If I'm going to buy a put at that point, I'll get back to it here. If I'm going to buy a put here, if I short the stock, what is it the stock has to do in order for me to make money? All right, well, unless the stock goes lower and you short the stock here, you buy a put, you can't make money. Zero chance. In fact, you probably lose money. But let's think about it. What can the stock do at this point, as it can at any given point? Well, it certainly can go lower, but it doesn't have to. It could also go sideways. And of course, it could go higher, right? So the stock can do one of three things at this point, as it could at any given point, right? Again, it can go lower, sideways, or it can go higher. Well, if the trade I've put on only makes money if it goes lower, the stock goes lower, but the stock can do one of three things, purely in probabilistic terms, I have a 33.3% chance of making money. That's a 1/3 chance of making money, all else being equal. In my world of generating these income streams for portfolios, that's essentially akin to gambling. So instead of making these directional bets, in which I can only make money in one direction, and I have to be correct not only in terms of direction, but also in terms of timing, spot on. Instead of making those kind of bets, we like to make a different bet, which is to say, we like to make a bet on where we think the stock is most likely not going to go over the next 1 to 2 weeks. So by making that bet, we, in this particular example, would make money whether the stock goes lower, sideways, or in this case, we would make money even if the stock could completely go against us. We could be buck naked wrong and go all the way up to 125, which at the time was like 8% against us. So instead of making that directional bet, we like to make a non-directional bet or a less directional bet. And so in order to do this, here's the example that we did at the time. At the time, we sold what's called a bear call spread. Now, this might sound more complicated than it is. It's super simple. It's literally just a couple of clicks of the button with your mouse on your broker platform, and you execute this as one trade. And so what we did is we sold a 125 strike call. We bought against that for protection a call at the 130 strike level or dollar level, and we received $1 or $100 per options contract, or $1,000 per 10 options contracts deposited into our broker account. That's right, when we open these trades, we actually receive money deposited into our brokerage account. And so by doing so, we can make money whether the stock goes lower, which is essentially our bet, if you will, sideways, or even in this case, 8% against us, because we're not making a bet on where we think the stock will go. We're making a bet on where we think it is most likely not going to go over the course of the next 1 to 2 weeks. Give me a quick yes if this is starting to make sense, and if you guys can see that this might be, all else being equal, a higher probability way of turning a profit in any given trade. And so in this case, you can see the stock did go lower, and I'll show you guys examples in a few minutes where the stock didn't do anything like that, and we still made just as much money. But in this case, the stock did go lower. You can see that spread was reduced down to 24 cents, which basically means that we got to keep the difference between $1 and 24 cents, which translates into $760 of profits using 10 options contracts. But again, the crazy thing is that the stock didn't actually have to go lower. It could have just as well gone sideways or even against us up to 8%. And that's a completely different way of looking at things. Now, what I haven't talked to you about is the options expiration that we use. And this is really, really, really important. So if you're clicking around on a different screen, I would urge you to just bring your attention back to the screen right now to really learn this. Like I said, it's only a couple of small changes that you probably need to make in order to have a much steadier stream of positive returns. And what we do is, at the time when we put this trade on, it was the month of February. You can see that here. But we didn't use February options. We didn't use options expiring in May. We used options expiring in April. And let's talk about why we would do such a thing. If at the time there in February, you would have used options expiring very short term, like a couple of weeks later, or God forbid the same week, and if the stock would have then immediately upon entry of the trade, let's say rallied 5% against you, you would have lost a lot of money. In other words, you have no room for error if you use these short-dated options. So if you have a car with 4 wheels, you would have just lost 3 wheels. And then you're done. You toast. Then you've just done exactly what I described earlier, that people do a few good trades and then 1 or 2 trades, and it wipes everything out again. But if at the time in February we didn't use these short-dated options, but instead used what we use, which is at the time was April options, if the stock then rallied against us, let's say 5%, we wouldn't have lost 3 wheels. We wouldn't have lost 2 wheels. We wouldn't even have lost 1 wheel. May have seen 1 tire deflate. In other words, we would have had a small loss. And that's really important in terms of risk management, because if you want to be a good trader and have a steady stream of positive returns, you need to be primarily a good risk manager. But most strategies that we see being taught out there to the retail community don't give them any good chance of actually even being a good risk manager. And that's why this is so different. Okay? So you can see that by using options that expire further out, but, and this is important, only holding these trades on average for 1 to 2 weeks, we have a completely different probability, much higher, of actually having a positive stream of returns. Starting to make sense? So let's have a look at a few more examples. You can look at this example here in shares of Tesla. And what you'll notice at the time is we had exactly what I just described. you had a steep drop, which was then followed by a vertical drop to the downside. And then at some point, the stock just got so oversold that we said, you know what, we don't feel comfortable buying it here, but we will feel comfortable making the bet that it's not going to drop more than another, I think at the time it was like 20%, that it's not going to drop more than another 20% over the course of the next 1 to 2 weeks. So what we did is we sold a put all the way down here at the 120 strike. We bought against that, a put at the 110 strike, and we received or got paid into our brokerage account at $2.25, meaning $2,250 with 10 options contracts. Now, in this case, again, you can see by March 16th, so a few weeks later, the stock did move to the upside, and that spread was reduced to 43 cents, meaning we got to pocket the difference, which is $1.82, or translating into $1,820 of profits using 10 options contracts. But again, the crazy thing is the stock didn't actually have to go higher. It could have just as well gone sideways or even against us to a pretty good degree, and we could have still made money. So these are just really, really important things to understand when it comes to being a good risk manager and wanting to have a more steady stream of positive returns in the markets. Here's an example of a trade that we did in the S&P 500, the SPY ETF, in March. And I'm using this example because I think a lot of people can relate to March in the markets this year. But also, I think a lot of people are probably familiar with the S&P 500 and maybe even the SPY ETF. So we found ourselves on March 16th. We found ourselves looking at the market and noticing that the S&P had just dropped, I believe it was 28% over the course of 3 weeks. And while we weren't ready to buy the S&P 500 at that point, that would have been too risky from a volatility perspective, we were willing to make the following bet. And the bet was that we didn't think that the S&P, after having just dropped 28% in 3 weeks, would drop more than another 18% over the ensuing 1 to 2 weeks. And so in March, we used June options, and we only held the trade for, as you can see, about 8 days. What we did is we sold a put at the 190 strike level, bought against that a protective put at 185, received $1,050 deposited into our brokerage account. But the crazy thing is that by March 24th, the S&P 500 was actually at the same exact level as it was on March 16th. But we managed to make an 11.4% profit, 11.4%. Think about it, if you would have bought a call or if you would have tried to buy the SPY there, you would have either stopped yourself out or just had a crappy loss. But we managed to make an 11.4% return because we were not in a trade that was as directionally exposed and as exposed to immediately having to be correct in terms of timing as if you were doing a directional trade. So this is really, really important. And really what it leads to is that because this strategy has such a high probability of making money, the objective here is not to pick winners, but instead when a trade goes against you, you just get out. And because when a trade goes against you in this strategy, you lose just a little bit of money, you are actually going to exit. Think about all the times when you weren't willing to take a loss because when a trade went against you, it went against you pretty hard in terms of P&L. The way we do things when the trade does go against you, you're not going to lose a lot of money, so you actually have a much higher probability of actually closing it out, meaning you're going to have small losses and a steadier stream of positive returns, right? So this is really, really important. Now, the way we look at this is we look at credit spreads as, you know, like your base income or your regular income. So when we come into every new month, every new week, what we do is we put on these credit spreads to really lay that base foundation of income. And then, of course, if you want to do additional things like some swing trades or day trades or whatever else you might be doing, you can certainly do that as well. But credit spreads themselves, the way we use the strategy is already a great way to build an additional source of income. And by the way, the average millionaire in the United States has 7 sources of income. So you might be thinking, can you have another source of income? This is a great way of doing so. Now, before we go into the live market, I just want to spend a minute playing this little game called Follow the Indicator. And you guys can see the blue arrows up here. Well, can you see what the stock did to the right of those blue arrows? Right, the stock stopped going higher. In fact, it went lower. But more importantly, it stopped going higher for at least 1 to 2 weeks, which is that time frame that we want to focus on. Same thing here in Alphabet. You can see you have a stock that after the right of the blue arrows, the stock stopped going higher for 1 to 2 weeks. Or here in this ETF here, you can see to the right of the blue arrow, the stock stopped going higher for a period of 1 to 2 weeks. And that's all we're looking for. So let's go into the live market, and I'm just going to go through some ticker symbols. You guys are happy to, welcome to type in some ticker symbol as well that you would like us to look at. And so you can see that not only that this works, but also, well, not only how it works, but also that it works. So the first one here was from Daniel, no, not Daniel. It was Emma. She wanted to look at NVIDIA. So let me bring over NVIDIA. And I have a different screen resolution on my other screen, so I have to continuously move this chart back and forth, just so you guys know. The last time NVIDIA gave us an overbought signal was here. And you can see what happened then. The stock stopped going higher for 1 to 2 weeks. In fact, it actually ended up collapsing 41%. So what do you do at that point? When the arrow no longer prints, which in this case would have happened on the 20th of that month, you sell a call, you buy a protective call against it, you take in the credit, you keep the trade on for 1 to 2 weeks, and then you move on. Do you see that, Emma? Yeah? So that's really, really important to understand. Nicola, this is from Dan. He wants to look at NKLA. Let's bring over NKLA, and again, so you guys know, I'm not making this up. I'm just taking your tickers and calling out your name. Dan, the last time Nicola gave us an overbought reading was here, and you can see on the 10th of June, excuse me, the stock stopped printing the arrow. What happened to the stock over the next 1 to 2 weeks? It stopped going higher. So what do? You sell a call up here, you buy a protective call against it, keep it on for 1 to 2 weeks, generate the income, and you move on. And by the way, the stock did after that drop like 40% as well, but that's the bonus payout. That's not what we're betting on. Okay. Do you see that, Dan, how that works? Yeah? Okay. Okay. How about the CRM, that is Salesforce.com. Bring that down here. Here's Salesforce.com. It gave us a bunch of errors, stopped printing the arrow on September 1st, and then what did the stock do over the ensuing 1 to 2 weeks? It stopped going higher. In fact, it's ended up dropping as much as 15%. That's not what we're betting on, but what we're looking to do is then sell a call, buy a protective call against it a little bit higher, generate the income, and move on and close the trade again after 1 to 2 weeks, right? How about Illumina? ILMN. I'll quickly bring this one down. And again, I have a different screen resolution on the other one, so I have to keep moving the screens back and forth. Illumina gave us an oversold reading on September 21st. On September 22nd, the arrow stopped printing. So what would you have done? Sell a put down here, buy a protective put to generate the income, keep it on for 1 to 2 weeks, and close it back out. In this case, the stock has already rallied 14%, and you could definitely get out for a really, really nice profit already. But again, keep in mind, the stock in this case doesn't have to go higher. It could have just as well gone sideways, or even quite a bit lower, right? So your need to be directionally dead on correct and to be dead on correct in terms of timing is dramatically reduced. And this is really, really important. I'll just give you a couple more. Is anyone here a day trader, by the way? Does anyone do day trading? Because I'm happy to show you how the indicator also works intraday. Yeah. Okay. So here's, for example, is Etsy. This is now a daily. I'll go into a day trading chart in a second, but you can see Etsy. We actually did this trade. You can see it stopped printing the arrow just a couple of weeks ago, or a few weeks ago, whenever this was. Bring this down, and you can see how the stock then went sideways to lower, and we made really nice profits. Target as well. Is another one that just comes to mind here. Just a couple of weeks ago. Sorry, let me bring this down again. I have to keep moving the screen here. This is Target. You can see here, stop printing. 1 to 2 weeks later, the stock was just gone sideways to lower. We keep the profits and move on. So just so you guys can see, like, if you want to look at intraday stuff. Let's look at, for example, I don't know, NDX. You guys want to look at NDX, for example. So this is right now live. Let me get to this. Where is this? Here is NDX. This is right now, NDX. You can see, and intraday, we don't want to use credit spreads, by the way, but you can see NDX just printed this morning at the open, and it then ended up selling off like half a percent. Now this is the day trading time, but I'm just trying to show you how this works. This has happened. This is right now. This is right now live, right? Or I don't know, like just something recent that everyone knows, like Zoom. Let's look at Zoom, for example. Let me bring you this. Where is this? Here is Zoom. Here. So this is Zoom right now. This morning, it printed at the lows of the morning, just as we did, or during the webinar. It printed, gave us the highs of the overnight. And let's go back yesterday. Printed the highs of the morning as well. So now again, intraday, you don't want to do credit spreads necessarily, but you can see how that's signaling, right? So what does this leave us with? As you've seen, this is a process that works. And so what I'd like to do is introduce you to the options income secrets, because that's why a lot of you guys were here today. You mentioned before that you are looking for that regular income, and you're looking to know how and why traders, maybe like myself that have done this for a long time, are able to produce these regular results month over month or quarter over quarter. And so what I'm going to do is I'd like to introduce you to what's called the options income secrets package. And what you're going to get is exactly the formula and everything included in order to help you produce regular income over and over again. And I'm going to give you that low stress, high probability cash flow income strategy. The benefit now is that it gives you steady and regular income into your account, meaning that you don't have to second guess trades, and you know every month that you have a reliable strategy to really put the odds in your favor and dollars into your account. Now with this package, you're going to learn how to use options the way that the pros do. The benefit is that you start trading with confidence and you start trading with a process, and it gets a little easier every day until it becomes essentially second nature. I'm going to give you a cheat sheet as well, so you're not alone, because trading is all about having a process, and I really can't emphasize it enough. So when you follow a cheat sheet, it's there exactly for that, is to follow a process. And I do want to give you that edge in the market, which is why I'm going to give you the indicator and the scanner that I just showed you here as well. So this is not only about education. I want you to have an edge in the market like all the pros do. And there's a reason why winning traders win, and it's not only based on knowledge, right? So I'm also going to throw in the vertical export indicator and scanner. Now, I want to just quickly show you guys how the scanner works, how we find these ideas, and how quick it actually takes. Like, for example, you can see, let me bring down the chart again, which is here. So you can see, for example, there's an overbought scanner and oversold. So the overbought, let's click on this one, BBBY. That's Bed Bath & Beyond. And you can see, bring down the chart. You can see just by clicking on that, it brings up this chart. It's overbought, and we're going to look to put on, guess what, a bear call spread. Once the arrow stops printing, we sell a call, buy a protective call against it, and move on for income. So it's super, super simple to use. You can install it on Thinkorswim, and I'll go over this again in a minute, on TradeStation, NinjaTrader, at TradingView.com, and it's also on our Market Ruler Pro. And again, I'll go over this a bit more in a minute. But I think, what really makes this indicator so great, the Vertical X Pro, is that it gives you access to the highest probability options income trading setups. So I'm going to give you a platform and a foundation that whether you're new to trading or whether you've been trading for a while now, that you have this strategy and you have this tool that you can rely on month over month, quarter over quarter, just create that regular income. And that's exactly what this does. So what are you going to get? Well, you're going to get everything you need in order to generate a much more positive stream of income. Again, you might be asking yourself, can I do this? Absolutely. It does not require a lot of time, and we're going to throw it all in with one easy to follow package. So the profitability of these signals is 80%. And when a trade goes against you, you're going to lose a little money. We have also throwing in an iron condor module, a cheat sheet, and of course, we're going to throw in the indicator, and I'll touch much more on the monthly members webinars we do every single month. Dave, for example, wrote us the other day. You can see if you watch the videos, you actually follow this, then you can make good, steady income. You can see what some other people are saying. Great indicator, great strategy. It's my bread and butter strategy. And it really, really works, folks. Like, it's a matter of actually being willing to stick to something that works, that gives you a high probability of turning a profit quarter over quarter, month over month. If you are more into trading for entertainment, this is probably not your thing. But if you are serious about it and you actually do want to generate another source of income, and think about it, if you have another source of income, what would that allow you to do? Would that allow you to have maybe a bit more freedom, a better life for you and your family, and just to be less stressed in front of the computer when you trade? And what we're really going to teach you as well in the live webinars and the video course as well is how to turn this into a regular income machine, right? We're going to help you, teach you how to diversify this among different sectors and industries, groups, and even asset classes if you choose to do so. And so the way it works is, if you break it down, you're looking at a package that if you only were to get the video course, that would come out to $199. If you wanted to get the live monthly scanning sessions, we do 1 or 2 a month, and I'll talk much more about those in a minute, where we give you a trade idea every single time. We teach you exactly how to use a strategy and indicator. That'd be $497. The indicator itself would be almost $2,000. The Iron Condors Made Simple module is essentially priced. So the total package value here is $2,693. We're going to take 90% off for the next 50 people. And that comes out to a one-time price of $297. That's not a recurring fee. It's not a monthly fee. It's not an annual fee. It's not a quarterly fee. It's one time, and you're a lifetime member, which is $297. Again, it's limited to the next 50 people. And the reason it is limited to the next 50 people, and this is honestly true, is because we don't want to take on too many people at once, because we want to be able to give each and everyone enough attention to really teach you this and make sure you understand it and you make money with it as quickly as possible. Really importantly is the members sessions. And I just want to spend a couple minutes on this. Every single month, and I mean every single month, we do 1 to sometimes up to 3 members webinars. And I can prove this to you. And so once you get to the website and you're logged in, you can go to indicators, and you click on Vertical X Pro, and there's the instructions of how to install the indicator on the different platforms. If you have a different broker, like, I don't know, Interactive Brokers or Fidelity, then you can install it on TradingView.com. It's essentially a website you can create a free account on. But just so you guys can see what we do in these member webinars, you can see we did 2 in September, we did 3 in August, we did 1 in July, a couple in June, and in May 2, April 2, March 2, and every single one of these webinars, and this is essentially for life, we give you a trade idea, an actionable trade idea, where to get into the trade, where to get out, this in great detail describe it to you. And we're also going to teach you, of course, how to use indicator and scanner all in one session every single month once to up to sometimes 3 times, but a lot of times it's 2 times a month. So if you want to learn something that actually works, it gives you a positive stream of returns, this is a great thing. If you are asking yourself, what if I don't have a lot of money? Well, if you don't have a lot of money, that's the best part about this, because you're going to make sure that for just $297 as a lifetime offer deal, you're going to squeeze every last drop out of this and actually learn how to make this work, right? That's the best part about it. If you don't have a lot of time, again, that's the best part about it, because it doesn't require a lot of time. It doesn't require you to be sitting in front of your computer a lot to put on the strategy and to really learn how it works. Let's see, yeah, the way you get it is you go to www.studytradersecrets.com/secrets. David was kind enough to also type that into the chat box. I appreciate that, David. So I can give you some examples. Like, for example, I just talked about a couple of them. Like, we actually offer people a trade idea on the NASDAQ 100 to do a bear call spread in our members webinar in late August. That was literally right around here. I think it was August 28th or something, and that was a very profitable. Trade before that was in Target. The trade before that was in Etsy. Those are all bear calls. So we give people an exact entry strategy and exit strategy, exactly which trade to do. And again, we do this each month. So this is not just one time, not just twice. Every single month we give you these trades, and we teach you exactly how to use the indicator and scanner and how to use the strategy as well. The scanner, again, just quickly want to go over this. If you are looking to use a scanner, again, we also show you how this works. Like this, we just did this before a second ago. We just literally clicked on the overbought signals today, like BBBY today happened to come up, and you can see how that comes up with this signal right now that we are looking to put a spread on as soon as it stops printing, which may be as early as tomorrow. We'll have to see. So that's it, folks. I hope this was helpful. Again, this requires just a small change in your strategy to have a much steadier stream of positive returns. My support staff is going to send you the recording of the past webinar as well. The one we just did, I think we just did it like on Monday this week. And again, they're all on the website as well, of course. So again, you go to indicators, and you're going to get an email as soon as you get in. You get this. You're going to get an email. You go to indicators, DST Vertical X Pro, and then you can use the installation instructions here and also click on the past webinar recordings to watch them. Excellent. Well, I'm glad you like it, Emma. The thing about this here is so the trades are they're offered in the webinars, and the webinars always get recorded, Kersey. So as soon as, if you can't make it live in the webinar, and remember, these trades are not super time sensitive. They're not day trades, right? So when we do the trade, it's still going to be viable at least the same day, a lot of times even the next day. So but again, we do this every single month. So if all you want is a couple of trade ideas, $297 for life, for a couple of trade ideas a month is probably a pretty good deal. But again, the point is also to learn it so you have another income stream.